Who doesn't like free stuff? We think everyone's down with that. In the investment world, you might have heard of major brokerage companies like TD Ameritrade, Fidelity, Robinhood, and Charles Schwab, doing equity trades with zero fees. The new innovation of the zero-commission broker is an attractive concept. A lot of people transfer their capitals to these platforms, and for understandable reasons. These services entice beginner investors to buy and sell stocks without any commissions. Traditional brokers can say the same. Some traders even cost around $20. So for people looking to grow their money, a zero-commission broker sounds like a great deal. However, like most people say, if it sounds too good to be true, then it probably is. What's the catch to this free commission feature? What are the potential caveats that come with it? Let's find out. Hey, welcome to Stock Market Mate. In today's video, we'll talk about the real price of zero-commission brokers. Before we get into it, make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Disclaimer though, despite the drawbacks that we're going to discuss, zero-commission brokers still have plenty of benefits for investors. In fact, the concept of zero-commission brokerage has expanded to accessibility of investing for people with small account balances. These are the people who can barely afford fixed dollar commissions every time they invest their money in the stock market. Zero-commission brokerage serves them well. That being said, it's still essential to understand and know where your money actually goes. Before we discuss the hidden cost of zero-commission brokers, let's first understand what it actually is. A broker is a person who buys and sells stocks and other securities based on a client's request. While you can purchase a mutual fund from a specific company, stocks and ETFs can only be bought on exchanges. This is simply an exclusive marketplace wherein registered members trade securities. This is where brokers come in. They provide access to their clients. They can find buyers and sellers for the client's orders. Traditionally, clients would pay commission to the brokers per trade. It usually costs around $20 per order. This may be a small amount to some, but beginners may not be able to afford the price of buying and selling individual securities. Thanks to zero-commission brokers, you can now buy and sell without the hefty trading commission fees. Suddenly, zero became the new normal in trading commissions. Robinhood actually pioneered this concept, and soon enough, institutions like TD Ameritrade and Charles Schwab followed right after. Zero-commission brokers have been praised by a lot of investors. Though it lacks the features of expensive and premium brokers like trading charts and research reports, it is free and everyone loves free. But what are the actual hidden costs of zero-commission brokers? Let's start with the first one. Widening the bid-ask spread. What actually happens when the bid-ask spread is widened? Basically, tighter spreads are an indicator of greater liquidity, while wider bid-ask spreads occur in less liquid or highly volatile stocks. When a bid-ask spread is wide, it can be a challenge to trade in and out of a position at a fair price. This means that when you trade a stock in your account, you almost instantly lose money compared to the market price. This is because of bid-ask spreads. To compensate the market maker for constructing a market in a stock, you typically don't receive the market price when you buy or sell. You pay a little bit higher than the original price when you buy, but receive a little less when you sell. Of course, a brokerage may provide an unappealing spread for you regardless of fees. But the lack of trading commissions means that less efficient trading could be an excuse for brokerages to take revenue from trades in a way that's less obvious to the customer, such as routing trades in a way that leads to wider spreads. Next, payment for order flow. Supporters of payment for order flow can say all parties can win. So how does it work? A broker sends a commission-free retail trade to a wholesaler or market maker. It does this instead of sending trades to the traditional stock exchanges because market makers say they can provide better prices. The market maker then matches buyers and sellers, or more often, buys or sells the shares itself in order to later buy or sell them to match orders. A portion of the better price is passed back to the customer in the form of what's called price improvement, after the market maker takes its profit on the spread between the buy and sell prices, and some of that profit goes to the broker as an allowance for steering the order its way. That's the payment for order flow. Where things get complicated is exactly how the benefits of price improvement get divided. The truth is that there is no regulation or rule to how it's split. As a result, payment for order flow is a conflict between the broker's best execution duty to customers and its obligations to shareholders for maximizing its own profits. Robinhood claimed that market makers provide better prices than exchanges, and that it earns a fixed percentage of bid-ask spread, which is the same rate across all its market makers, so it has no incentive to route orders to a specific market maker. They say there's no such thing as a conflict of interest, but they haven't actually disclosed what it pays. And that seems to be an important question in figuring out the actual financial gain of retail investors. Because of this, Robinhood paid a $65 million civil penalty to the SEC for not telling its customers over a number of years that it was using payment for order flow and for not giving best execution on orders. So while you may not see a fee on your account statement from this practice, it's not impossible that it could lead to a bad execution price at your expense. Foreign exchange. If you ever purchase the stock in a currency that is different from your account currency, you'll probably be charged a hefty amount. For example, in Canada, where it's not new to hold US positions, Wealthsimple Trade charges 1.5% on US dollar trades. This isn't the same case with Robinhood, since the app doesn't allow you to purchase foreign stocks. It's quite surprising that a lot of people are unaware that they're paying for an FX fee when they purchase a foreign listed company. And honestly, brokers may not have been doing a dedicated job at fully disclosing this information, and this is why it's often overlooked. This is what brought Robinhood into the hot seat. Incentivization to trade. When you are asked between not paying fees and paying them, the first choice will be a no-brainer. However, plenty of these platforms have made trading a little too easy. Stocks or even more complex derivatives such as options can now be purchased and sold with a simple tap on your smartphone. This is why it's not hard to give in to trading impulses. This is all planned out. This has the same design as Instagram or Facebook, which are programmed to make you keep scrolling. Brokers have included countless features to keep its users interested in the market. This includes the incorporation of networking features and smartphone notifications. The more you trade, the richer these platforms will be. People have even accused these platforms for gamifying their investments. Recently, Robinhood has yet again got into another issue when they removed the confetti feature from buying a user's first position. The combination of accessibility and enticing offers causes people to day trade rather than focusing on long-term investments. This may not seem like a big deal, but according to scientific research, not only do plenty of trades give lower returns, they also prove that day traders actually lose a lot of money. However, at the end of the day, it all boils down to your choice. People are also getting more informed about the risks and benefits that come with investing. Nobody should be restricted on which kind of investment they prefer. But the problem lies with the fact that these platforms seem to focus on beginner investors who know nothing about how the market functions. You might have noticed that TikTokers are all over social media, teaching people how easy it is to buy crypto and individual stocks. Of course, the platform that hired these TikTokers are not targeting the seasoned investors, but the clueless ones. Even with the aforementioned hidden fees, we're not fully against zero-commission brokerage as they have helped a lot of people build their investment journey. But the problem is that plenty of retail investors are using risky strategies that may affect their users. We can only tell you to have discipline when using these zero-commission brokerage platforms, because after all, in essence, they are financial institutions trying to earn their keep. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!